This is part of our series called Insightful Ideas from Smart People. And in this video, we feature a very smart person. He's actually a Nobel laureate in economics by the name of Fama. And he had a position which he initially stated on CNBC, which got into a heated debate. But what Professor Fama calmly laid out, and what seemed to fly in the face of conventional knowledge, was that the fact that since 2008, the Fed had started paying interest on excess reserves, and since most of QE has ended up back as excess reserves, that the process of QE is essentially exchanging short-term debt for long-term debt, which, as he said, is essentially a non-event in terms of the Fed's balance sheet. So the Fed never used to pay interest on excess reserves pre-2008, and when that was the case, excess reserves were almost always less than 10% of total reserve holdings, because depository institutions didn't want to leave money there without earning any interest. Then, in October of 2008, the Federal Reserve Board, as part of a program to help put a floor under the federal funds rate, announced that it would begin paying interest on depository institutions' excess reserve balances, which has averaged 25 basis points per year. Now, the funds were used to purchase long-duration bonds and mortgage-backed securities. If they bought those securities from, say, a pension fund, the pension fund would have to go back and reinvest the proceeds in some other asset. If they were buying the bonds from average Joe, and Joe does not spend that money into the real economy because he needs those funds for his retirement, the funds get deposited into Joe's bank account, and the bank then has excess reserves which they redeposit with the Fed. But at the end of the day, regardless of who sold their bonds, the proceeds ended up back as excess reserves with the Fed, on which the Fed was, since 2008, paying 25 basis points of interest per year. So as Fama laid out, QE effectively amounts to exchanging short-term debt for long-term debt, a non-event other than perhaps some impact on the shape of the yield curve. And so we look at the evidence, and this is what it looks like. The blue line shows treasuries held by the Federal Reserve, and you can see the various phases of QE as it ramps up. And the red line shows the excess reserves of depository institutions, and you can see that they pretty much match each other. So everything that has been pushed out as QE has come back as excess reserves. However, what's happened in the meantime is that the money doesn't seem to go back in as excess reserves on the first transaction. It makes a few round trips, like the pension fund example we just described, and during those round trips, it is pushing up prices of financial assets. And so people get that money, they buy stocks, someone else gets that money, but eventually it gets redeposited. But with all those round trips, you can see that asset prices have climbed along with QE. But the money is not getting into the real economy. This is net domestic investment as a percent of GDP. It's 3%, very low compared to its historical average. So that's the real issue. It's actually not driving economic growth. And then the other benefit, which is quite interesting, is that the interest earned on those bond purchases by the Federal Reserve actually gets transferred back to the Treasury. So you can see that as a line item in the budget. It's actually helping reduce our budget deficit by maybe 20%. So I guess that's good for the government. So we think that Professor Fama makes a very good observation that from the central bank balance sheet perspective, it's not a big deal. As to QE's effectiveness, QE probably has had some impact on consumption, but has not had a material economic benefit on investment, and has mostly just inflated asset prices. So that's it for this video. Thanks.